Here's what they're not telling you about what just happened in Shanghai. 22 accounts suspended in 7 days on one of the world's largest commodity exchanges. Not over months. Not spread across quarters. 7 days. And the mainstream financial press is burying it under headlines about inflation data and tech stock rallies. This isn't regulatory housekeeping. This is a coordinated crackdown on manipulation so blatant that even the exchange, which profits from volume, had to intervene. The Shanghai Futures Exchange doesn't just wake up and suspend 22 trading groups unless the game being played threatens the entire system's credibility. Mathematical certainty. When enforcement actions accelerate at this velocity, you're watching the endgame of a manipulation scheme that can no longer hide its footprints. Let me show you the pattern. Pattern. Same sequence. Same outcome. Rome didn't fall because barbarians showed up one morning. Rome fell because for 2 centuries, emperors debased the denarius from pure silver to nearly worthless base metal wrapped in a thin silver coating. Citizens who saved in denarii watched their purchasing power evaporate. The state paid soldiers and suppliers with fake money. By the time Diocletian tried to stop the bleeding with price controls, it was over. The currency had lost all credibility. Trade collapsed. The empire fragmented. Verified. Check the metallurgical records. The silver content dropped from 95% to 5% over 200 years. Then the empire ceased to exist within a generation. The Dutch Empire controlled global trade in the 17th century through the guilder, backed by the wealth of the East India Company and the Amsterdam banks. Then came the wars with England and France. Debts mounted. The temptation to print became irresistible. By the early 18th century, the guilder was being debased to fund military campaigns that couldn't be won. Merchants who once settled accounts in Amsterdam guilders switched to bills of exchange backed by physical goods or English sterling. The Dutch lost reserve currency status not in a dramatic crash, but in a slow bleed as trust evaporated. Within 50 years, Amsterdam was a regional power, not a global hub. Verified. Check the currency flow records from London and Paris trading houses in 1700 to 1750. Britain held reserve status for over a century because the pound was as good as gold. Then came 2 world wars and a welfare state that required printing money the empire no longer had the productive capacity to back. Bretton Woods gave them a reprieve by linking everything to the dollar, which was linked to gold. But by 1967, the pound had to be devalued. The game was over. Oil contracts moved to dollars. Trade invoices moved to dollars. Central banks dumped pounds and bought dollars and gold. Within a decade, Britain went from empire to a country taking IMF loans just to keep the lights on. Verified. Check the sterling devaluation of 1967 and the IMF bailout of 1976. Same pattern. Same sequence. Same outcome. Accumulate wealth through production and sound money. Overextend through war and welfare commitments. Debase the currency to pay for promises that can't be kept. Lose reserve status as trust evaporates. Collapse into irrelevance as the next power rises. The cycle has repeated for 3,000 years across every civilization that tried to print its way out of insolvency. Not opinion, pattern recognition. And right now, the United States is in the final act of this exact script. Here are the numbers they don't want you calculating. U.S. national debt is $36 trillion. Debt to GDP ratio is 138%, higher than any point except World War II. Interest payments alone are now over $1 trillion per year, more than the defense budget. Social Security and Medicare are functionally insolvent without massive tax increases or benefit cuts that will never happen politically. The Congressional Budget Office projects deficits of $2 trillion per year for the next decade, even without a recession or war. That's the optimistic scenario. Not might happen. Will happen. Every single projection assumes moderate growth, low interest rates, and no crisis. Remove any one of those assumptions, and the numbers become apocalyptic within 36 months. Now look at what's happening in the commodity markets while everyone is distracted by stock indexes hitting new highs. Registered silver at the COMEX is down to 93 million ounces after bleeding 5 million ounces on Friday the 13th alone. March open interest sits at roughly 60,000 contracts, which represents 295 million ounces of paper claims. That's a coverage ratio worse than 3 to 1. There are 3 times more paper contracts claiming silver than physical silver registered to deliver. And that's after 6,000 contracts mysteriously rolled from March delivery to May, pushing the problem 2 months down the road. You don't roll contracts out of strength. You roll because you can't deliver and you're begging for time. Meanwhile, in Shanghai, the premium for physical silver over the Western paper price just exploded to $9 per ounce, up from $7 last week and $6 the week before. When physical metal in the East is trading $9 higher than paper contracts in the West, that's not a pricing anomaly. That's 2 different realities. One market trades real metal that people can hold. The other market trades digital entries that multiply infinitely because there's no enforcement of allocation limits. The premium is expanding, not contracting, which tells you Eastern buyers are paying up because they understand Western paper is becoming untethered from physical reality. The Shanghai Futures Exchange just suspended 2 more account groups overnight, bringing the total to 22 suspensions in 1 week. The exchange specifically cited trading violations related to overnight silver futures manipulation coordinated with U.S. traders. When you see enforcement ramping up like this, the exchange is saying the manipulation crossed lines even they won't tolerate, and they profit from volatility. Check SHFE Article 16 Enforcement Disclosures. It's documented, publicly accessible, verifiable. 22 suspensions in 7 days is not normal regulatory activity. That's a crackdown on a scheme that got so obvious it threatened systemic credibility. And here's the kicker. The Shanghai Futures Exchange is closing for Chinese New Year holidays starting Sunday, reopening February 24th. They're closing with 353 tons of physical silver in their vaults, which equals roughly 11 million ounces. Total open interest for their February and March contracts is approximately 360 tons. That's essentially 1-to-1 coverage with zero buffer. Shanghai has barely enough metal to cover its own paper claims, which means there's no safety valve left. Previously, if COMEX got squeezed, arbitrage could theoretically pull metal from Shanghai. Not anymore. Both exchanges are now operating at the edge of their physical capacity simultaneously. Let me show you what the attempted shakeout actually accomplished. Almost nothing. The banks orchestrated massive downside pressure, slamming silver 11% in coordinated selling across thin markets. And they managed to extract only 2 million ounces from SLV, the largest silver ETF. That's confirmed by the roughly 2 million share drop in SLV's reported holdings. The wash trading during the session was off the charts, with only 2 million shares net sold overall. When you execute maximum manipulation, create 11% downside, and only extract 2 million ounces from the biggest ETF, that tells you holders aren't panic selling. They're not even flinching. Check SLV shares outstanding data reported daily through custodian disclosures. It's publicly accessible and verifiable. Only 1,500 long contracts were shaken out of the March delivery queue despite the entire orchestrated collapse. 1,500 out of 60,000. That's a 2.5% reduction in delivery pressure after a week of maximum suppression effort. When manipulation requires coordinated everything sell-offs across equities, commodities, and risk assets simultaneously, requires algorithmically spoofing prices in thin overnight markets, and still only shakes out 1,500 contracts and 2 million ETF ounces, that's not strength. That's desperation masked by volatility. The smart money is leaving the paper game and standing for physical delivery at record rates because they see what's coming. We are not at the cliff. We have already walked off it. The illusion of stability exists because the system is complex enough that most people can't see the mechanism failing in real time. Let me make it visceral. Imagine you wake up Monday morning and your bank app won't load. Not because of a glitch, because your bank doesn't have the liquidity to process withdrawals, and they've implemented a temporary hold while they sort out a margin call from a derivatives position that went wrong over the weekend. You call the branch. Voicemail full. You drive there. Closed. You check the news. 3 regional banks have suspended operations pending emergency Fed intervention. The Treasury Secretary is on TV saying your deposits are safe and insured, which is exactly what they said in Cyprus before they seized 40% of accounts over 100,000 euros. You go to the grocery store to buy a week of food while you wait for this to sort out. Except prices have moved. Not 2%, 20% since Friday. The store manager explains their supplier is only accepting wire transfers, not credit terms, because banks aren't clearing payments normally. Half the shelves are empty because trucking companies are demanding cash up front for fuel. You try to pull cash from an ATM. Daily limit $400. Except there are 30 people in line and the machine runs out after 7. This isn't a screenplay. This is the mechanics of liquidity collapse when faith in the clearing system breaks. It has happened in Argentina, in Lebanon, in Greece, in Cyprus. It will happen here. Not might happen. Will happen. Because the math doesn't work and there's no politically viable path to make it work. Now connect this to what's happening in the geopolitical chessboard that the media is deliberately misrepresenting. Bloomberg leaked a supposed Kremlin memo claiming Russia is rushing back to the US dollar under Trump. The reality is completely inverted. The internal document lists 7 possible areas of cooperation with the US, but only after Ukraine peace and major sanctions relief. Using dollars in bilateral trade is one conditional suggestion to stabilize reserves and reduce volatility. This is brainstorming inside the Kremlin, not official policy, not surrender. Russia's trade with China and India is now 90 to 95% in rubles, yuan, or local currencies since 2022 sanctions hit. BRICS internal trade reached 60 to 67% without dollars. That's a massive shield against Western financial pressure built over 3 years of necessity. Any dollar use with the US would be narrow, temporary, and fully conditional on compensation for frozen assets. Russia learned the hard way about over-reliance on a weaponized dollar system when $300 billion in reserves were seized overnight. Repeating that mistake wholesale makes zero sense when they've successfully built alternative payment infrastructure. Here's what the Kremlin made very clear in its response. If the US lifts restrictions on dollar use, they will have to compete with alternative currencies increasingly being used in the world for settlements. The yuan will continue growing as an international currency. Same applies to the ruble and other currencies. The days of a single world reserve currency are over. There is no need to have one, and no nation with a functioning brain would aspire to being the world reserve currency going forward. China certainly doesn't want that burden. You can't unsee it once you understand reserve currency status is a liability disguised as privilege. It requires running perpetual trade deficits, exporting your manufacturing base, and ultimately debasing your currency to service debts you can never repay. Connect this to why gold keeps rising despite these propaganda narratives trying to claim de-dollarization is reversing. China's treasury holdings are at the lowest level since 2008. China is urging its banks to cut dollar exposure as well. India has reduced holdings too. Meanwhile, both nations are accumulating gold aggressively. Less paper, more metal. When the largest foreign holders of U.S. debt systematically reduce dollar exposure while accumulating physical gold, that's not temporary repositioning. That's a structural shift in how global settlement works when trust in the dollar system erodes. The rally in gold began in 2022, exactly when the U.S. weaponized the dollar against Russia by seizing reserves. Central banks globally started moving from treasuries to gold for real safety. Not because they hate America, because they watch what happens when you hold your wealth in a system that can be frozen by executive order. No major crisis has hit yet. No bank collapses, no forced massive QE programs. But analysts warn that domestic debt problems and private equity stress will trigger it soon. The new Fed chair nominee Kevin Warsh wants lower interest rates to rebuild industry plus smaller balance sheets simultaneously. History proves that's impossible without printing more money. Reserve shortages already forced QE-style treasury buying in December 2025 to prevent a repo market seizure. When the domestic crisis arrives, new QE money stays trapped inside the US while gold becomes the preferred global settlement asset outside the dollar system. Russia's conditional exploration of dollar use under strict terms doesn't change this trajectory. It shows pragmatic flexibility, not retreat from de-dollarization. Unstoppable dollar weakness and the coming crises are setting gold and silver up for the most explosive moves yet. Let me give you the technical update for anyone trading the paper markets short term, because you need both sides of this. Silver is currently at $77. In the last video, I said if 74 holds, we have potential for an inverse head and shoulders pattern developing. Silver crashed to exactly 74, bounced, rallied to 79, and is currently at 77. That 74 level acted as support precisely as the technical structure suggested. But, and this is critical, we haven't seen violent displacement yet. We need base formation first, proper volume confirmation, and a clear break of resistance with follow-through before validating a bullish thesis. You don't catch falling knives. You wait for confluences to build. The 150 exponential moving average on the hourly chart is now at 81. That's resistance overhead. As long as price trades below 81, the technical structure shows continued vulnerability to the downside. If price reclaims 81 with conviction and volume, that shifts the entire setup. Until then, caution is warranted for paper traders. This is tape reading education showing you key levels that matter for risk management, not a signal to go all in. The bearish case matters because you need both sides to make informed decisions. Silver at 77 hasn't reclaimed 81 resistance and could drop back towards 74 or lower if support breaks. Shanghai closed for 8 days creates the manipulation window we're in right now. Banks still have tools to suppress the paper price through concentrated shorts, derivatives, leverage, and SLV arbitrage mechanisms. 6,000 contracts rolled from March to May, showing that delivery pressure can be postponed through contract management and cash settlement enforcement. 1,500 longs shaken out isn't massive capitulation, but it's still a reduction in delivery demand. March contracts could roll further to avoid physical settlement. COMEX has contained these situations repeatedly throughout decades of documented manipulation. JP Morgan paid $920 million in September 2020 in case number 1:1970438, admitted guilt, then returned to the same desks executing the same trades. Paper manipulation persisted before and can persist again. But here's the counter that changes everything. Shanghai premium is $9 and expanding, not contracting. Physical in the East is commanding bigger premiums, while Western paper consolidates. SHFE is closing with 11 million ounces versus 360 tons of open interest, which means essentially full allocation with zero buffer. COMEX has 93 million registered versus 295 million in March claims. Only 1,500 contracts were shaken out despite a massive manipulation effort. Banks extracted only 2 million ounces from SLV during the entire shakeout. 22 exchange account suspensions in 1 week. Silver bounced exactly from 74 as the technical structure indicated. That's not coincidence. That's support holding where analysis suggested it would. When manipulation requires massive coordination, thin volume, and everything sell-offs across asset classes just to extract 2 million ounces and shake out 1,500 contracts, that's not strength. That's desperation masked by volatility. Here's what to watch over the next 8 days while Shanghai is closed. See if 74 support holds. See if 81 resistance breaks with volume. Track March delivery into the 27th. Watch the Shanghai premium on the 24th. This isn't prediction. It's observation. Same pattern. Same sequence. Same outcome. Empires don't fall overnight. They lose credibility until reality hits. Right now, we're in the phase where manipulation still works on price, but it's failing on fundamentals. They can smash paper prices on low-volume nights, but they can't create physical metal. They can't stop Eastern buyers from paying premiums. They can't erase delivery pressure when coverage is 3-to-1. And they can't suspend dozens of accounts and pretend everything is normal. Liquidity is so thin that every move leaves fingerprints. Every slam takes more coordination. Every shakeout delivers weaker results. When decades of suppressed price discovery unwind, they don't unwind slowly. They snap. This isn't chaos. It's a wealth transfer. Throughout history, when fiat systems fail, wealth doesn't vanish. It moves. From paper to physical. From promises to assets. From those who trusted the system to those who studied it. Smart money already sees this. Central banks are buying metal, not bonds. Institutions are rotating into hard assets. Private wealth is increasing physical exposure. They see the debt spiral. They see the coverage ratios. They see the premiums expanding. You can't print trust. You can't QE your way out of a credibility crisis. The math doesn't lie. The pattern always completes. Position accordingly.